Hey everyone, and welcome to CoveredCall ETF Investing. I'm Jordan, and today we are going to be jumping inside the CoveredCall ETF All-Star Tracker spreadsheet I've created to help income investors, like many of you out there, to shuffle through and make sense of the chaos out there when it comes to CoveredCall ETFs. And that's something that's in the description below if you want to pick that up for yourself, if you like what you see. I am running a discount, 50% off for the month of March as this channel turns 2. So time flies when you're having fun, and you guys make it easy to come back week after week to share some more and different insights into the income investing landscape, especially when it comes to CoveredCall ETFs. But today we're going to go through the Canadian tab, fund manager by fund manager, looking at things like performance data, yields, AUM, distribution changes, and try to kind of make sense of the most current economic environment that we find ourselves in, right? A lot of heartburn being caused by tariffs. Sentiment is like way down. It's spooking the real estate market here in Canada. And of course, importers on both sides of the border are going to be facing some massive costs coming up here if Trump makes actual good on it. He says he will, but if he actually makes good on his promise to impose tariffs on everybody. So should we stay the course? Where should we make adjustments in our portfolios to deal with all this? Well, hopefully a video like this can try to maybe answer some of those questions. So let's get into it right now. All right, I'm going to get rid of my screen just so that we can make the entire screen as visible as possible. So what we're going to do is we're going to go through each fund manager, especially the fund managers that have a substantial CoveredCall ETF suite. So BMO ETFs, Brompton Fund, CI Financial, Evolve ETFs, Global X, Hamilton ETFs, Harvest portfolios, and to round it out, we'll also go through Purpose Investments as well. Yeah, there's a couple other smaller fund managers, but we just want to focus on the ones that have substantial suites to them. So let's filter by fund manager. We'll clear it out. We'll keep the indexes, and we'll start with BMO. Let's just start with yields. You'll notice right away there's nothing over 10%. Typically, that's sort of my target range is 10% plus. When we talk about funds on the channel, so that's probably why you don't see me talking about BMO ETFs all that much. They're considered some of the most conservative fund managers here in Canada, and I guess they have all the right to be. I mean, they were some of the first fund managers in the game, and they've racked up significant AUM, big bank, focusing on CoveredCall ETFs. Anyway, they got into the game early. They got tons of AUM behind a lot of these funds, and so why change what's not broken for them? As far as funds that are trading off of a 52-week high discount, so this would be as for an example, ZWA, its price is 5% less off of its 52-week high currently. Well, at the moment, it's really just tech and energy at the moment for them that are kind of the ones that stand out at the moment. And as far as recent history in sort of our latest economic cycle, there's not really anything in here that has seen a substantial drop in that. And so that kind of just goes to show the kind of conservative approach that BMO does take with some of these funds. But I mean, you're going to see something that we probably haven't seen in a long time from BMO once we get to the distribution changes in a moment here. And as far as management fees, they're right in the typical range of 65 basis points. Here's what I was talking about with their AUMs. They're probably the only fund manager that have a multitude of over $1 billion funds. And ZWB is probably it's no doubt the biggest one in Canada. Not just by a little, but probably, double than, say, ZWC. And then it'll probably be at least 3 times bigger than, say, the next fund manager with, I want to say Harvest might have one, HHL, I think, is $1 billion. HMAX from Hamilton in the $1 billion ballpark. Anyway, so healthy AUMs, awesome AUMs. Once again, why change what isn't broken? Now, when it gets to distribution changes, probably for the first time, this is the first I'm seeing this, but ZWH, which is the BMO US High Dividend Covered Call ETF, that got a 30% change from 10 cents to 13 cents. Its USD version went from 10.5 to 12.5 cents. And then check out ZWT. It got a massive leap forward, almost 50%. And the BMO US High Dividend Covered Call ETF also got a 16.67% increase as well, which is great to see. These guys don't really raise them all that often, once again, just by that kind of conservative nature. Now, I also wanted to highlight one fund in here in particular, and this I think should be, we should take note of, because this is maybe one way of seeing kind of where money inflows are going to. And basically, it's going to be this European stuff. So we're going to highlight all the European stuff because all the European stuff is doing awesome. So whether it's the sentiment, the uncertainty around tariffs, but money is flowing into Europe, and especially the cover call income stuff. So people who have been getting on the European train, maybe over the last few months, you're being rewarded right now, that's for sure. Next up on our list is Brompton funds. Now, I would say with Brompton, the big star or the king of their suite is BMAX. It's their all-in-one. It basically holds everything that you see here. They're not exactly, with BMAX, not replicating any particular index. It's a hodgepodge mix of things like volatility and North American financials and global infrastructure and healthcare and tech leaders, right? So it's a wide range mix of all those different sectors. Now, when it comes to the actual yields itself, again, BMAX also is probably the highest yielder. Everything else is pretty conservative. But the only way BMAX can actually get here is also by its leverage component, which is at around 33%. So at any rate, let's see what's trading off of its 52-week high. We can see that healthcare taking a bit of a hit from, at least on this side of things, from Brompton. BMAX holding up. Now, I own BMAX, and I really do. I've said this for a long time. It's almost like a buoy in the portfolio. It might not excite you with the yield, but you're right. For me, it's always kind of hovered around that 10%, 10.5%, maybe a little bit lower than 10%, but it kind of always hovers around that range. And it seems to have this ability, when times are good, it goes up, and when times, right, it's almost like the fund managers, because a lot of these funds have up to 100% coverage ratio. I think Brompton seems to do a good job at leaning defensively when the market is struggling. So BMAX, I would say, more of a defensive play. I don't know if they would say that, if Brompton would say that, but from a retail investor like myself, I like to kind of think of BMAX as a little bit more defensive minded than some of the other all-in-one funds that are out there. But anyway, moving on to performance in our most recent economic cycle, there's not really anything that stands out huge. I mean, maybe you could say, right, the global infrastructure down a bit. Tech, no surprise there, as there's a bit of a market rotation going on. Right, things are moving out of tech at the moment. So there could very well be opportunities there, right? The market probably gets frothy again at some point. Especially if the money printing gets going again. TLF would benefit from, no doubt, quantitative easing, but Anyway, we'll move along to, what else do we got here? Let's go over to AUMs. What are we looking at for AUMs? We can see that TLF, the highest out of all these, at 120 million. Second place BDiv, and then we got BMAX at 92 million. And we see that it's the only fund that has 33% leverage as well. And as of right now, they have not raised their distributions month over month. You can see lifetime changes against some of the first distributions. Take TLF for example, or at least the dollar US dollar version's risen like 273% in what, like 6 years. That's great. So some great distribution increases in that period of time. Next is CI Financial. Now, this fund manager in particular, we don't often talk a lot about these guys, but I would say the biggest thing for them, and one of the reasons I don't often talk about them, is their distribution schedule. So it's quarterly, and they have variable distribution. So unlike many of the other fund managers here in Canada, which are stable distributions, they're monthly distributions. The American covered call ETF fund managers are, for the most part, even though they're much more variable, are also pay out monthly as well. But anyways, you got their tech funds at above 10%. A lot of sector covered call ETFs in here. Let's see, how is the 52-week high discount column? Well, we can see energy. We saw that a similar fund, ZWEN with BMO, where energy was kind of way down. So that trading off its 52-week high by 16%. How's tech doing? Tech down 10%. And what else do we got here? Right, Lifeco's also down 13% as well. How about performances? Anything that really stick out in the near term, like the last month or so? I mean, February has been a brutal month. And this is probably, we're feeling some of the hardest heartburn that we've felt in a long time. Again, when the market is unsure about what the direction of, right, the biggest economic driver in the world, which is the U.S. Stock market, where it's something like 2/3 of all global stock markets is in the U.S. So if the U.S. catch a cold, right, the rest of us catch a fever is, I guess, probably the best way to think about it. But anyway, with CI's funds, nothing's really down huge at the moment. Now, as we move along, you can see again, payout frequency is quarterly. Their management expense ratio, or I should say, well, just their management fees are pretty standard at 65 basis points. They are probably the fund manager that writes up to the least amount of portfolio coverage at 25%. They just got the one fund at up to 100%. And let's see their AUMs, their biggest fund being TXF, the tech fund. And then, of course, this is also an older fund manager as well. So it's not like some of these AUMs don't look like terrible at all, despite what I might say about I should say variability in their distributions and being quarterly. These guys have been around for a long time. They were actually pioneers in the space here in Canada with their covered call ETFs. But it might just be time to tweak some of this stuff a little bit. I know Global X has done that back when they were Horizons. They did a similar facelift with a bunch of their funds, and sometimes it's just needed for the better. And I think CI genuinely, I think, could really benefit from that. And I'd love to see another competitor in the space just to make some noise. And as far as distribution increases are concerned, I know it looks stable, but that's just because I'm carrying over the same distributions month over month from January. It's just basically is to say that from I want to say third quarter in 2024 to January, nothing has changed. It might be like September to December, something like that. But anyway, the only other changes would be the fact that CCBD is actually a monthly distribution, and CIC has changed to go monthly. So maybe they might be testing the waters with these two funds. They do lag behind a little bit, whereas the other funds are, you see them in the March column, but these two funds have not announced their distributions yet. That'll come later this month, so that's why they lag behind a month. All right, this is where things start to get really interesting. We're getting into the fund managers that I would say for the audience's most part, this is some of your more favorite fund managers. Some of your favorite funds are in here. We're getting into the spicier yields, we're going to start with Evolve, and you can see like basically so much of their stuff is above 10%. Always, this is like a dark horse favorite of mine. Base. I've had this on my watch list for so long. And I got to say, it being over 10%, this is actually a rarity for this. Now they did make a splash this month with their distribution increases, so we're going to get to that in a minute. And I want to also mention, like we said at the top of this video, pay attention to some of the European funds. So EBNK is another one to really look at. As far as what's trading off the 52-week high, we got their tech fund QQQY down almost 15%. Utilities down almost, down 12% as well. So that fund taking the biggest, those two funds taking the biggest hit at the moment. As far as recent performance, you can see QQQY is taking the brunt of that at the moment. Market rotation going on right now. People are getting out of the highest flying performers that basically propped up the market last year. Probably 10 companies propped most of it up last year. So bit of rotation, and it's quite evident in the tech sector at the moment. So EBNK, let's look at this. Isn't a mistake. Where's the 1 month or year-to-date performance? Year-to-date performance, like I looked at that and I thought that was a mistake. Like there's no way. No, that's actually real. In 2 months, you're right at the time of recording this European Banks Fund is up 16.68%. So, I mean, that's why I'm saying money is just, when we're talking about rotations, it's just going into Europe like nobody's business right now. So, again, if any of you got into some of these European funds, and especially EBNK, you're laughing right now. Moving along. They got some of the lower management fees out there. We saw with a bunch of the other funds like Brompton, CI, and BMO. These guys trade about, on average, I mean, it's not totally across the board, but right, it's maybe somewhere in the ballpark of 15 to 20 basis points lower than some of those other fund managers out there. And then check out some of the AUMs. Let's go to Bank is probably the most notorious one that's been seeing some really healthy month-over-month AUM growth, along with Bond is another one. What else do we got here? Life is always one. That one's another consistent AUM grower as well. And then when we go to talk about distribution increases or streaks, I should say, you can see these guys. I actually can't think of off the top of my head when they actually did cut their distributions, but you can always find that out in the distribution tracker here. You can actually you can cycle through that, and if there's any particular fund manager, you can see if they've cut it in their history. So that would be the tab if you want to actually research that a little bit further. I'm not looking at my portfolio at the moment. Let's stay on task. And then when it comes to distribution changes, so EBNK performing quite well, and then finally ESPX finally gets a raise. This one definitely deserved a raise. It didn't receive one last year when many other similar diversified CoveredCall ETFs were getting raises. So ESPX takes a raise. Along with its subsidiaries, its unhedged version and its USD dollar version, and then ETSX, right? This one also got a 17.5% raise as well, so that's great to see. And let's just highlight those yields for a moment here. Yeah, okay, so it pushes ESPX to 11% when it was probably sitting before this raise, maybe at around, call it 7%. I want to say maybe 7.5, somewhere around there. And same with ETSX, even though it gets to be, it's actually not as high. I actually thought it would be higher than ESPX, but that's not the case. So I think, if you're looking for an unleveraged version of an index an index cover call ETF looking at the S&P 500, ESPX might be a solid choice for you. We got some other audience favorites in here as well. Global X, lots of solid yields in here. It's much more of a diversified mix of yields. You get some above 10%. I would say probably half their funds above 10%. The other half in a much lower category here. So some that are worth noting are like the ENCL yield, the king of the energy cover call ETFs here in Canada, as it focuses on Canadian oil and gas. EQCL, this one's a favorite of mine in terms of like watching its AUM grow, simply because I probably started investing in this fund when it was around $9 million. So it was a little bit of a, at the time, it was a little bit of a, if you want to call it a risk, I'll for lack of a better word, I'll just call it that. But since then, I really had a strong inclination, confidence that this fund would eventually start to catch on. And ever since then, month over month, it's again healthy grower. Probably sits at around 30 million AUM at the moment. It's a bit of a tortoise when it comes to its growth. You're not going to see massive explosive growth with EQCL, but it is an all-in-one fund that invests in things like the S&P 500, the Nasdaq 100, the Russell 2000, developed markets index, and an emerging markets index as well. So I just like the general geographical exposure to it. And of course, things like QQCL and USCL sort of round out, I would say, the top favorites when it comes to investing in things like the Nasdaq 100 and the S&P 500 with leverage. So what's trading at the 52-week high discount in this column right here? We can see, no surprise. Where's QQCL? You know what? Not down as much as I thought it would be. Actually, and it's kind of right in line with USCL. Kind of a surprise there. No, what's taking the bigger hit is the two energy funds, the non-leverage fund and the leverage version as well. And then kind of rounding out the most recent hit is actually this gold miners ETF. So, and as we scroll along to performance over in the last month or so, what kind of sticks out? Like I said, it's probably the energy funds at the moment, and GLCC ever so slightly. Well, we can actually see this is where QQCL is taking the hit in the tech sector, is right here at almost 5% here in the month of February. And let's face it, February we got hit pretty hard. So again, stay the course as best you can. Let's not relent, especially there's tons of noise out there right now. It's sometimes best just put the phone down, turn the TV off, and just remember why you're invested in these funds to begin with. So let's move along. Pays out monthly. It's management fees, a little bit all over the place, right? You have some lower ones, even in some cases lower than what we saw with Evolve, and in some cases right on par with Evolve, and then in other cases just a lot higher. If we go over to AUMs, where was I? Was I right with QQCL? All right, so yeah, 31 million. Steady grower, that's for sure. But I would say some of the biggest growers of all is actually, well, ENCC's been around for a long time, so almost at $500 million. GLCC, we kind of skipped over the performance of the past year, but it's done insanely well. I want to say over the last year or so, it's probably done like 42% total return. So gold miners, gold in general, done really well if you got into it. I know many of you have. You've taken on that play, and of course, it has not let you down in any real form. And then distribution streaks. 2 months ago, they cut some of the distributions around BKCL, BKCC, CNCC, CNCL. So there's a bunch of funds that got the cut. Luckily enough for me, I own EQCL. That one got a distribution increase, along with QQCC, QQCL, USCC, and USCL as well. But this month, negative. Nothing has increased. They don't typically raise their distributions all that often. So they basically did a mass distribution increase and cut sort of in the same month. So But I would say for the most part, most of you watching are probably proud owners of USCL, QQCL, EQCL, and maybe ENCL, ENCC as well. And I'm not gonna really touch on any of the bond stuff. They're a bit newer in the sense they've maybe been around for a year and a little bit. But anyway, that's not exactly where the excitement is at the moment. Another audience favorite is Hamilton ETFs. Let's go through some of their yields, their performance data, AUMs, their distribution changes. Now, they do have a favorite in the sense of HYLD. HYLD probably makes up about half of my overall portfolio if you spread it across my wife's spousal RSP, my TFSA. Yeah, it makes up about half of that. It's not always going to be like that. I would say in a couple of years it should kind of revert to the mean and maybe be 15% of my overall everything. But until that time, it will remain at quite a large chunk, especially with I should mention HYLD.U. That's what's in my wife's spouse RSP, and the regular HYLD is in my TFSA. Now, they got a bunch of sector funds. Their Maximizer suite, as you can see here in a lot of their names, looking at different sectors. They focus on sort of in that, right, 10 to 14% yield range, roughly. It's actually a pretty solid range to be in. Especially for the diversified funds, 10 to 12%, I typically like to say is that nice sweet spot where you get a solid yield, but if it's diversified well enough that it has that potential to naturally grow itself, especially if it finds itself in a hole, covered calls, naturally cap upside, that's just how they work. So harder for them to grow, especially it depends on how aggressive they are with their cover call writing. So those that are a little bit more conservative in nature, but still able to produce that 10 to 12% yield, able to grow it, HLD is one of those funds in particular. Got some good stuff going for it. In the 52-week high discount column, what's taken a beating? Real estate, that shouldn't come as a shock at all, but wowee, look at this. EMAX down 20% from its 52-week high. H-bond, I should say H-bond down 12%. Those are some of the highlights off the 52-week high. But in more recent times, what through here is taking a bit of a beating right now? Actually, you know what? It's going to be things like QMAX, SMAX, which make up a bulk of HYLD. And these, of course, are stock selected, concentrated versions of the NASDAQ 100 and the S&P 500. So if these two suffer, HYLD suffers. It's got a little bit of some of those other sector funds in there, but the overall vast majority of it is in SMAX and QMAX. Moving along to, let's see, their management fees. 65 basis points, right in line. Keep in mind, if you see 0% with the all-in-ones, they are ETFs that invest in other ETFs. So those underlying ETFs is where you're paying the management fee. You're not double dipping. So if you invest in an ETF, they invest in ETF. There's only going to be one management fee, but typically you'll see 0% if it's an ETF that invests in other ETFs. Take a look at AUMs. HMAX over $1 billion, so congratulations to HMAX. And HYLD, right? It's at $750 million in the 3 years that it's been out since February of 2022. And even some of the index funds, QMAX, SMAX, really healthy. And as far as distribution changes are concerned, we're looking at... Now, they do have some variable distributions. You can expect that from the sector funds, even from the diversified funds like SMAX and QMAX, slightly diversified, but it's their all-in-ones like HDIV and HYLD, HYLD.U is where they seem to lock in the stability, and I actually really like that. I actually owned HDIV at one point. I do plan to get into it again. It's about 75% Canadian, 25% American. I know Canada's not, the sentiment around Canada right now is not, it's not like a great place to invest in at the moment, but right where there's where there's exodus, there could be opportunity. So something to consider there. Some of the most exciting yields out there is currently with Harvest ETFs, another highly reputable fund manager here in Canada. They've also branched out into single stock ETFs, which is giving Purpose Investments a run for their money, since those guys have had single stock CoveredCall ETFs around for a while. Now Purpose is getting in the game, and you're seeing some incredible yields from like 35%. But you can tell as we move down the forward yield column here, it's a lot of single stock ETFs that you're able to generate these kinds of yields, especially with some of them that have leverage on them. But I would say, as far as their launches of single stock ETFs, I would say the one that captures the most attention is going to be that HHIS fund, which is an all-in-one. So basically it combines a bunch of these single stock ETFs with a yield of 26%. So this fund, we get back to one of the central arguments I was talking about a little bit earlier in this video, where part of my strategy has always been to try to look for diversified funds with maximum potential price performance with maximum potential yield. And what does that equilibrium look like? Well, HHIS, since its launch, basically that is the new high. Now keep in mind, it's very highly concentrated, and the more concentrated something is, there is that potential for outperformance, for higher yield. But what is rocket fuel can also be an anchor. So that's just something to keep in mind with HHIS. I made a video on this of how I was going to talk about I might invest 100 grand into it. But really the gist of that video was to say that I'm going to hold out for a couple of distributions just to see how it goes. Kind of happy I did, because February came along and upset pretty much everything, including HHIS. So what is trading off of its 52-week high? We're on HHIS, and you can see it's down almost 18%. Yeah, I would say that basically this fund manager is seeing probably the highest heartburn imaginable with everything that's down right now. But again, some of these are single stocks. Like, that is the ultimate concentration in an ETF, when it's just one stock. It's just one thing, and we're seeing all anchors out right now. At the moment, of course, with in the most recent history, what's kind of taking the biggest beating at the moment, and that's going to be things like, again, it's just a mix of the single stock ETFs. So we'll move along. Distribution payouts monthly, no surprise there. Management fee structures, they're on the more inexpensive side at 40 basis points for the most part. What else we got? AUMs. I actually want to highlight HHIS because this thing has just rocketed to the top. I think it's got something like $128 million at the moment. There we go. Yeah, $128 million. It is far and away the best performer of all their recent launches, which are basically those single stock ETFs. And keep in mind, HHIS also has that 25% leverage component. Let's go over to dividend streaks. They have some of the highest dividend streaks of all the CoveredCall ETFs out there. We got plenty of them above 100. And then when it comes to distribution changes, nothing to report this month. Everything is pretty good there. I mean, I actually like the fact that I see. Yes, I would love to see increases. Who wouldn't? But the fact that these things are stable month over month, I'm also excited for just 0% as well. I mean, if it's not going to be an increase, what would I rather take? I'd rather just be steady. And Harvest, very well known for keeping it pretty steady. Last but not least, we got Purpose Investments. For the longest time, Purpose was probably the most easily identifiable kind of fund manager. They were the niche fund manager. They had funds that, some of the first Bitcoin stuff out there as far as ETFs are concerned. First Bitcoin CoveredCall ETF, at least here in Canada. and a bunch of single stock ETFs. So they really carved out sort of a nice niche for themselves. But of course, Harvest is really chipping into the single stock side of things. Now, a lot of their info, because like what you see in yellow here, yellow indicates that it trades on the neo exchanges, is actually a very difficult spot to grab live information from. I've continued to struggle with finding something that will actually stick. Sometimes I do find something and then it might stop working after a day or two. So anyway, there's not much to speak about when it comes to the 52-week high. We can't really see anything there. Same with performance data. We can only kind of speak to the year-to-date stuff, and we can see a lot of stuff is just down, down, down in the dumps as far as performance is concerned. And again, management fees. A lot of the management fees, now that we've been through a lot of them, many are competing in that 40 basis point range, which is great to see, and instead of that sort of typical 60 to 65 basis point management fee range. So we'll go over to AUMs. Biggest AUM right now is YTSL. These guys don't have a diversified fund at all. So it's basically you're either going to pick them up for their single stock ETFs or their crypto or their one sort of Canadian financial income fund, which again has a great distribution streak at 110 months. And then as far as monthly increases are concerned, we got 0 across the board as far as monthly changes are concerned. So that pretty much wraps up the lowdown on what's kind of going on in the world of income at the moment. We're getting certainly some elevated yields across the entire stock market right now, at least those that are oriented around cover call ETFs. So there's certainly opportunities in there, and yields were certainly decreasing, with the AI boom. But now that it seems like we're kind of getting out of that, yields are going up. So, and again, there could be opportunity where people are running out. Maybe you get into it then. But hey, that's for you to decide. So if you like the information that was provided here, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.